back to EDS, and in this video I'm going to show you a step-by-step simple strategy that I back tested for you to prove to you that it works no matter which way the market is going. And after we've gone over the back test, I'm going to show you how to implement it, and that's going to allow you to generate positive returns without needing to know which way the market is going to go. So as you can see here, we have a back test open. This specific underlying that we're going to be looking at is Intel. The reason why we picked Intel is because it's a pretty small underlying, and it will fit well in almost every single portfolio, even the smallest portfolios. And if you have a larger portfolio, you'll be absolutely fine. So the strategy setup is a strangle, and a strangle is where you sell one call and one put. So as you can see here, we have been selling calls and puts at the 20 delta with 45 days left on the contracts, and this back test is over the last 3 years, so it's a pretty good sample size. And we were only in a trade, one trade at a time, so one trade at a time. We did not have multiple trades open, just to keep things simple. When the maximum active trade number is reached, we did not enter a new trade. That's just confirming that we only had one trade open at a time. And we only entered trades when the VIX was above 20. Now, in reality, you wouldn't need to worry about whether the VIX is above 20 or not. You'd look at the VIX to manage your portfolio at the portfolio level, not necessarily at the position level. However, IV rank, it was not a metric that we could actually select on this back test, so I put the VIX in there just to kind of simulate a high implied volatility environment. In actual reality, you just want to make sure that the IV rank on the underlying is nice and high, i.e. over 30 or over 50 even. But that's what the VIX metric here is for. It's just simulating a high IV environment. And then our exit conditions were that we either close the position at 21 days left till expiration, or we close the position as soon as we hit 50% of max profit, either one, whichever came first. Now, if we take a look here, we have the gray line that shows us the price of Intel. So if we were to just buy Intel 3 years ago and hold it, we would have actually been down 58%, as we can see here with the buy and hold strategy. However, by selling consistent strangles in high IV environments, we were actually able to generate a positive return, even though the actual underlying itself went down. Now, this would be the same thing if, the market went up, sideways, whatever. It doesn't matter. The whole point of a strangle is that it's delta neutral, it's directionally neutral, which allows us to make money no matter which way the underlying goes. So as you can see, overall we made a profit of $348. If we were to buy and hold, we would have lost $600. We made an average P&L per trade of $20.52. We had a max drawdown of $21, but we're only using $1,000 in capital anyway, so it was a small drawdown of $271, which wasn't really too much, to be honest. And overall we generated a 32.9% return. Now, you do need to keep in mind that this back test does not take into account any adjustments. So any losing trades, it just closed as losing trades. But in reality, we wouldn't just be closing losing trades. We would be making adjustments. If our strikes were to get breached, we would be rolling out in time, etc., minimizing the amount of losers. So these sharp drops here, we would be able to minimize them significantly, if not get rid of them completely, and our profit curve would actually be much smoother. But even without taking into account adjustments, it's still a profitable strategy. As you can see here, there was this period where it's just a straight horizontal line. That's because the VIX was below our entry threshold. In other words, IV wasn't high enough for us to actually take a position, so we didn't. Now, do just keep the VIX thing, take it with a pinch of salt, because like I said, we wouldn't be looking at the VIX. This is just to kind of emulate or simulate a high IV environment. So in actual reality, we would be using IV rank, and I'm going to show you exactly how to do it. But the purpose of showing you this back test is that the strategy works. Okay, we can clearly see here Intel dropped down by over 50% in value. However, this strategy still made a positive return. So that's the back test. Now I'm going to show you how to actually place this trade. So you want to have Intel open and you want to go over to the trade tab. Now, as we can see here, our IV rank next to Intel is 73.8, which is super high right now, and that's really good for us. We only want to be entering when the IV rank is at least 30, or even better if it's over 50. And as long as you're doing that, you don't need to really look at the VIX. I'll show you what to do with the VIX later on in the video, but right now IV rank is at 74.4, which is perfect. Another one of our entry criteria was that we were looking to get in on contracts that had 45 days left till expiration. Now, we don't really want to be looking at weeklies or month or quarterlies. We only want to look at monthly expiration dates. Now, as you can see here, there isn't a monthly expiration date with 45 days left on the contract. That doesn't mean we're just going to sit here and not make money. So what we're going to do is we're going to widen our range. So anything between 30 and 60 days is fine, as long as it's still a monthly expiration. So we've got 36 days left on this contract, March 21st, and that is a monthly expiration date. You can either go to March 21st or you could go a little bit further out to April 17 with 63 days on it. That's just a matter of personal preference. I would personally go with March 21st. We'll get more aggressive theta decay. So we're going to open that up, and now we are presented with the options chain. In the back test, we were using 20 delta. I personally like to be between 15 and 20 deltas. I use 20 because that's more aggressive. However, you will have a higher probability of success the lower your deltas are. So anywhere between 15 and 20 is fine. So we've got calls on the left, puts on the right. This horizontal orange bar shows us where the price of Intel currently is with respect to the strikes. In the top right, we have the IV level, which is 64%. And in parentheses next to it, we have the expected move, which is plus or minus 3.09. And that is visually represented with this vertical orange bar here. And we've also got these dotted blue lines that show us our standard deviation levels. So what we want to do is we want to sell one call and one put, and we want to sell them outside of the expected move, because when we are short contracts, which is what writing contracts means, when we are short contracts, we want price to stay away from our contracts. We don't want price to breach our contracts. So when we already know what the expected move is, we just need to sell outside of that expected move, and we're going to get a high probability of success. Now, the further out you go, the higher your probability of success will be, but the lower your return on capital. So that's why I like to be around the one standard deviation level, which will line up with about 15 to 20 deltas. So if we start off on the call side, as you can see, we have our delta column. We've got a 15 delta here at the 31 strike. And on the put side, we have a 17 delta at the 21 strike. So now what we've done is we've created a range for ourselves. Both contracts are outside of the expected move. Both contracts are in and around the one standard deviation level, and both contracts are between 15 and 20 delta. So this is a good trade setup so far. Now, we want price to be within this range that we've created at the point of expiration, which is in 36 days time, and the probability of that happening, as we can see in the bottom left corner, or our POP, which is probability of profit, that's our probability of making at least 1 penny on this trade. So we've got a 72% chance of making money on this trade, which is super high. Now, in the back test, you remember that we actually took profits at either 21 days till expiration or 50% of max profit. So if we look at this P50 number here, which is our probability of hitting 50% of max profit at some point in the trade, it's currently sitting at 83%. So we would have an 83% chance of this trade working out in our favor. That is before taking into account any adjustments. That is before taking into account that our implied volatility is generally overstated compared to actual volatility. So in reality, our probabilities of success would be higher, but we're looking at an 80+% chance of success here if we want to get out at 50% of max profit, which is what we want to do. Now, how much money can we make? So if we were to get filled at this mid price here, 81 cents, after that's multiplied out by the contract multiplier of 100 for equities, we would get a max profit of $80. So we would collect $80 up front, that would get added to our cash balance as soon as this trade gets filled. And our broker is going to require $244 in buying power to open this position. And this is one of the reasons why I said at the beginning, Intel is very good for small accounts, small portfolios, because you only need less than $250 to open this trade. And this is a naked position. It's an undefined risk position. As many of you probably already know, undefined risk trades require more capital, more buying power than defined risk trades. But when you have a small underlying like this, there's no need to cover your shorts because your buying power requirement is so low to begin with. You may as well just leave the position naked, enjoy your higher probabilities of success, and get higher daily P&L. So that's with at 15 delta. You can be more aggressive, go to the 19 delta. We're just going to leave the put side at 17 because the next one up is 25. As you can see now, we're collecting just under $90. We're getting more and more premium. Our P50 is still 83%. Let's just say for argument's sake you wanted to go to the 25 delta on either side. Now we're collecting $128. Our P50 is still 75%. Very, very high probabilities of success. This is all you need to do to make money. You need to do this over and over again as many times as you can, get as many occurrences in as you can. We are running the casino business model, the insurance company business model. We want as many occurrences as possible. We want to roll the dice as many times as possible. We want to let the odds work out in our favor, and we want to do it when we have a very high edge, and we know what our edge is by looking at the IV rank. Okay, right now it's super high at 74, so the edge is very much in our favor. You know, going to the 30 delta in a situation like this wouldn't even be too much of a bad idea, if I'm being honest with you, because our edge is so high. We would collect $150 up front, and our P50 is still over 70%. But your general bread and butter is going to be between 15 and 20 deltas. Okay, so how do we use VIX to manage our positions at the portfolio level? How do we know how much buying power we should be allocating to our positions? Well, we've created a free position sizing template that's available for everyone to use. Link is in the description. Click the button and it will take you over to this spreadsheet. And the way it works is you enter in the size of your portfolio at the top. So say if it's $15,000, and then below that, this is where you now enter in whatever the VIX level is. So say if it's 21.4, and then everything will be calculated below for you. This takes into account the size of your portfolio, the volatility in the market overall. It will tell you how much buying power you should be allocating to your positions on a position by position basis, on a general portfolio level as well, and there's also an explanation of everything below. So as long as you stick to this, over the long run, you will be absolutely fine. If you would like to learn in more detail about what we do and how we do it, click on this button here, EDS Premium. The link will be in the description, and get yourself signed up. Inside you will have access to our portfolio that will show you the positions that we're placing, how we manage risk, how we make adjustments. There's a full course, so no prior knowledge is required. We will teach you everything that you need to know from start to finish. It's a private community, so if you do get stuck, you can speak with myself directly or with other like-minded individuals. There's a 100% money back guarantee. So once you've been through the full course, followed some of our trades, if after 6 months you are not profitable, we will work with you for free until you are, or you can simply request a full refund. So it's completely risk-free, and right now it's $9.99 a month to join. The price will be increasing. That's not a sales tactic. For anyone that's been around for a little while, you will know that the price was £1 a month. The first wave of members joined, and the first wave was full. Then we increased the price now to $9.99. Once the second wave is full, we will increase the price again. So the earlier you get in, the more you are rewarded. Whatever price you get in, that's the price you're locked in at for life. And the aim of EDS Premium is to teach you the skill. We want to give it to you and not keep you dependent on us. And once you've learned the skill, no one can ever take it away from you. You can keep it and take it with you for the rest of your life. It's a very powerful thing to know, and we aim to get you to that point of where you are completely self-sufficient within 6 to 12 months. You're always welcome to stay and be a part of the community, but within 6 to 12 months you should be good to go. So with that being said, I will see you guys on the inside.